Today, we're going to pull back the curtain on a tool that's kind of like an X-ray for the stock market. It lets you see the hidden fear and greed that's really driving prices. It's all about seeing what the crowd is actually doing with their money, not just what the headlines are screaming. So, let me start with a wild idea. What if the absolute worst headlines, the moments of pure panic when everyone is yelling, sell, 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 what if those were actually the market's biggest, brightest buy signals? It's a paradox, for sure, but it's one the smartest investors have figured out how to use. And this isn't just theory. Let's take a real-world trip back to October of 2022. You probably remember it. The market was getting hammered, the news was just awful, and fear was, it was through the roof. Everyone was just hunkering down, expecting things to get worse. But then, something totally unexpected happened. The market hit a bottom and just ripped 15% higher in a matter of weeks. So what on earth was going on? Yeah, this is a classic market paradox, where the absolute worst news seems to trigger the best results. And you know what? It happens a lot more than you'd think. The key to finally understanding why this happens, well, it all comes down to one single, powerful idea. And here it is. The crowd is usually wrong at the extremes. Now, don't get me wrong. The crowd can be right for long stretches in the middle of a trend, but at those major turning points, they're almost always on the wrong side of the boat. When that collective emotion, whether it's pure fear or total greed, hits an absolute peak, the market is basically primed to snap back in the other direction. So, how do we actually measure that extreme emotion? How do we know when we've hit peak fear? Well, believe it or not, there's a tool for that. It's called the put/call ratio, and the best way to think about it as the market's unofficial fear gauge. It gives us a hard number, a real reading of just how scared or how greedy investors are at any given moment. And the math behind it is surprisingly simple. It's just the total number of put options being traded divided by the total number of call options. The easiest way to think about it is like this. Puts are basically bets that the market is going to drop. They're like insurance policies against a crash, so they represent fear. Calls, on the other hand, are bets that the market is going to go up. They're all about greed. This ratio just tells us which side of the trade is getting way too crowded. So when fear totally swamps out greed, you see the volume of puts just explode compared to calls. That makes the ratio spike higher. It's a clear signal that pessimism is everywhere. And on the flip side, when everyone gets euphoric and piles into calls, the ratio drops, telling us, hey, maybe things are getting a little too giddy around here. Okay, so we've got our fear gauge. We can measure sentiment. But that's only half the story. The real secret, the part that actually makes you money, is understanding why. Why is it so consistently profitable to bet against the crowd right when they are the most terrified? This is the secret sauce of the contrarian. It all boils down to this one powerful concept called exhausted positioning. Just think about it for a second. If every single person who was scared enough to sell has already sold, well, who's left to push the market down? The selling pressure is just gone. It's spent. The supply of sellers has totally dried up. And all that's left are the buyers, ready to push prices higher. And this gives us a really simple two-sided rule book. When the put-call ratio is really high, that means the crowd is terrified, and for us, that's a buy signal. But when the ratio is super low, it means the crowd is greedy and complacent, and that's our signal to be cautious, maybe take some chips off the table. Is really just a way to put numbers to that classic Wall Street saying, right? Buy fear, sell greed. The put/call ratio just lets you quantify that fear and greed instead of flying blind and just guessing what people are feeling. All right, so enough theory. Let's put this thing to the test. Let's go back and finally solve the mystery of October 2022. What was our trusty fear gauge telling us right before that monster rally took off? On October 13th, 2022, literally right at the market bottom, the book-call ratio hit an incredible 1.82. Now, what does that mean? It means for every 100 bullish call options being bought, a whopping 182 bearish put options were being bought. The market was literally drowning in fear. But here's the part that really matters. That 1.82 reading, that put it in the 96th percentile. This wasn't just your average everyday fear. No, this was a historically rare event. It means that on that one day, fear was higher than on 96% of all other trading days. That is the kind of extreme reading that screams, hey, a major turning point could be right around the corner. So you see, this isn't about just winging it. It's a methodical process. First, you check the level.
Was it above that extreme 1.5 threshold? Yep, check. Second, you check the percentile. Was it a rare event above the 90th percentile? At 96%, that's a big check. And finally, you check the context. Was the news terrible? Was everyone bearish? Absolutely. When you get all three of those lined up, that's when a high conviction buy signal is triggered.
Now, this tool is incredibly powerful, but it is not a magic crystal ball. You've got to know the rules of the road to use it effectively. So let's quickly run through a few best practices and, more importantly, the common mistakes to avoid. Okay, the number one rule, the most important one, is to only pay attention to the absolute extremes. Anything in the middle is just noise. You're hunting for those rare 90th percentile events. And please, never use this thing in a vacuum. You always want to confirm the signal with other indicators, and most importantly, wait for the price itself to start turning around and prove you right. And here you have it, the quick reference guide. This is really the practical takeaway you can use. Anything over 1.5, that's extreme fear, a strong buy signal. It's time to start looking for things to own. Anything below 0.5, that's extreme greed, and it's a time to be defensive. And that whole neutral zone in the middle, that's when you just ignore it and use your other tools. At the end of the day, it all comes back to that famous and kind of graphic contrarian saying, the time to buy is when there's blood in the streets. The put-call ratio is really just a tool that helps you measure exactly how much blood there is. So the next time you see absolute widespread panic in the markets, you'll have a choice. Is this a crisis you should run away from, or is it the opportunity you've been waiting for all along?